It's Pharma. Very important to understand that the rally in Pharma, is this real, is this here to stay, or this is a multi-year trend? And also, where do we go from here, given that in the recent rally, IT along with Pharma has also made a strong comeback. Ravi Dharamshi joins us now to talk about markets, Pharma, valuations. Ravi, fantastic to have you back. Thank you for joining us. For a stock investor, this is a great market. This market surely has managed to climb the... Right, thank you very much. This market has surely managed to climb the wall of worry. But how long do you think this market will manage to climb the wall of worry?
As long as the worries persist, I guess. No, seriously, I think what we need to think, the way I think about this market is that Indian breadth of the market was in a bear market since 2018. It's quite a long bear market, considering that in the past 2 decades, the longest one we had was about 15 months in global financial crisis. So for nearly 2 years, mid-caps have been in a bear market. We were beginning to recover. Post the corporate tax cut, the markets had started to recover when the COVID happened. And it was like a capitulation move. So if you look at it, the March actually marks the bottom of the market in terms of valuations, in terms of sentiment, and probably even in terms of economic growth and corporate profitability. So if that is the case, then we are just 3 months into the recovery in terms of markets. I'm not talking economic terms. And if that is the case, then we should not be so worried about the next, maybe there is a 5-10% correction lurking at some point of time. But it does not look like this is going to stop anytime soon.
Ravi, markets are forward-looking. Markets always focus on rate of change, not what has happened, but what will happen. But historically, every time markets have got excited about a positive rate of change, whether it was 2017, 18, or even beginning of 2019 in terms of earnings recovery, markets have got it wrong. So why do you think this time around history may not repeat itself where markets and consensus gets it wrong again?
So you're absolutely right about market looking at being forward-looking and looking at the rate of change. So let me tell you what, this COVID has been a global synchronized policy-driven slowdown. But what it also did is it brought about a global coordinated monetary and fiscal stimulus provided by the central banks. So and add to that corporate loan guarantees and asset purchases. So what it did is it reset the expectations to a new low. So you know that chart, like last 8-10 years, how analysts have continuously got the earnings wrong. But this time, there has been a 30% cut in earnings expectation. So let's hope they are wrong this time as well. And this time probably on the other side. Because the expectations have been set so low now. And this is after a 9-10 year streak where you are constantly overestimating. There is a chance that this year you will actually end up underestimating the earnings. And this quarter till now has demonstrated just that. The fall in top line has been slightly lower than expected, but the fall in operating profits is in fact not there. A lot of companies have seen increase in operating profit margins. That tells you that their ability to manage the cost is very much there. And that we are actually, the corporate world is actually in a fine shape. A lot of the inefficiencies have been weeded out, and only thing that we need is a little bit of growth to come back. And the numbers will look fantastic because there is operating leverage and financial leverage that both will play out. So the odds are stacked in favor of being surprised on the positive side in the earnings over the next 2-3 year period. That's how I would look at it.
Fair point. So what has been your tone of activity, Ravi, in last 1 month? When we spoke last, you were a Pharma bull, you had overweight positions in Pharma. That's done exceptionally well for you. Good call. I'm sure our viewers must have benefited because of that. Are you still committed to your long exposure or overweight position to Pharma?
Absolutely. I think Pharma story has just begun after a break of 5 years. And people who are scared of it because the stocks have doubled in the last 3 months will miss out on a much longer term story. I cannot rule out a correction or a dip at any point of time. But you need to be looking to buy. The story has just begun. What started off with oral drug pricing bottoming out and some increase in the pricing in US generics is now what we are witnessing now is API growth is coming back strongly, and Europe as a geography is also coming back strongly. So it is developing more legs. The story is developing more legs, and the numbers you can see in this particular quarter, some of the numbers have been eye-popping. So the surprise still remains on the upside. The story has just begun. The valuations are just north of the long-term average. That does not mean it has to correct in a big way. So we are positioned for pharma to have a much longer bull run. And it is definitely one of the leader of this particular market now.
So let's understand the criteria when pharma does well. For pharma to do well, you need global demand, you need pricing power, you also need strong domestic demand, and you need an environment where in general exports are allowed. We are in an environment where domestic demand is slightly subdued, and the environment perhaps is not something which will promote exporters, whether it is in India, the whole thesis of Atmanirbhar Bharat, or whether it is in US where America first comes in.
No, actually, contrary to that, I feel the exports are really picking up in a big way. Atmanirbhar means being self-sufficient for sure. So there are lots of imports. We need to replace the imports with domestic production. But that does not mean we are going to replace exports with domestic consumption. So, and what we need for the pharma bull run to continue is a profit to keep growing. And profits are growing. You are right, domestic pharma market is still subdued, and that is clearly shown in the performance. The stocks that have performed in pharma are not the domestic focused one in the last 3-4 months. It's all been export oriented companies. And clearly the US and Europe as a geography are making a strong comeback. So I think the pharma export story and India's pharmacy to the world, being the pharmacy to the world story continues. And it's only likely to get stronger because China is weakening itself because of its various news.
How many pharma stocks do you own, Ravi?
Number of stocks doesn't matter. What we have is nearly 35-40% of our weightage in pharma. So, but we run a very concentrated portfolio, so we don't own too many. We would rather pick and choose our stocks. We will miss out on some stories. That's okay. We don't want to be there in every story that is doing well. We would rather be allocation to equities is the first thing that you need to get right. After that, you need to get your stock picking right. And I think we are focusing on that. So, I mean, you've been interacting with me, so you know our biases. But pharma, 35-40% weightage is the max I think we can go, and that's where we are. That just reflects our conviction in the sector.
So let's spend a minute more on understanding where the pharma curve is moving. You know, pharma companies, they started as cheap substitutes, let's say a couple of years ago. Then that migrated into complex chemistry. Then that is now migrating into the whole thing of biosimilars. Where is the wave now moving towards post-COVID? Which Indian companies genuinely have capability and adaptability to forge higher? You know, when the pharma bull run started a couple of years ago, everything went higher. It was like a rising tide where Tom, Dick and Harry, every pharma company or every company which had a prefix or a suffix pharma, that company was in demand.
Yeah, so this story started way back in the late 1990s and early 2000s. When the generics opened up, the US market opened up for generics, and there was a gold rush. So there was a huge rush, and the low-hanging fruits were obviously the oral solids. So that is the place that actually got the maximum competition. And we, in a span of 10-15 years, went quickly from 4 or 5 people targeting a particular opportunity to 15 people to 20 people targeting on day one launch. So 2015 saw the culmination of that, and the competitive intensity was at its peak post 2015 till 2019-20. Now that number of competitors has reduced again from 15 to say 5 to 7. So which has brought the pricing back. So one segment is the oral solids, where we have actually maxed out our potential, and it has been 90-95% genericized. That India completely dominates. But the profit pools that still remain to be targeted incrementally are inhalers, biosimilars, oncology, injectables, maybe to some extent dermatology. So these are, which includes all kinds of specialty complex generics as well. These are the segments which are slightly more difficult to target. And by nature, there will never be 15 people targeting these products, because it involves a lot of capital investment. It involves a lot of time period, a lot of legal tangle, a lot of IP protection to these products. So it becomes difficult to target these products. So which is a good thing for the generics as well, because if they do manage to crack it, they will probably enjoy a longer run. And those profits are unlikely to erode the way oral solids profit eroded in the last few years. So which are the companies? I think all companies in a varying degree are targeting those opportunities. But more than therapeutic area, one needs to really focus on particular drug where the competition is likely to be the least, and where the generic company is likely to have a good long runway with less amount of competition. So yeah, that's what it looks like.
Now, Ravi, like a common friend of ours always shares with us, Mr. Junjunwala, which is that market price is a function of EPS and PE. So let's split that into two. EPS is a function of earnings and growth. Which end of the market do you think, apart from pharma, can give EPS and growth?
So before I get into this EPS and PE, I just would like to say that a lot of people are worried about market being at a PE multiple of 26, 27 or even higher. But this entire PE looking high is more because of earnings being low. And this earnings being low is a 10-year trend. It is not that it started yesterday or something. Since 2008, the corporate profitability to GDP has dipped from 7% to closer to 1%. And in that period, the GDP has actually doubled. So the profit pools have shrunk for the last 10 years for a corporate world as a whole. So clearly, PE is looking expensive, but the operating margins are at a low, profit margins are at a low, growth is at a low. From here to bet that profits are going to collapse is a little silly. Now, having said that, the recovery is not going to be immediate, and recovery is not going to be even. So there are some sectors where we believe the recovery has already started, and there are, over the next 18 to 24 months, we will keep seeing some of the other sector that will keep reviving. So currently the sectors that have clearly taken the lead in terms of revival are agri and rural focused sectors. One over there, agrochemicals, two-wheelers, tractors, equipment, any business that caters largely to the rural economy is going to do well. And that part of the economy actually did not do that badly and is going to recover faster. Second is, of course, pharmaceuticals that we spoke about. I'm not going to dwell too much on that, but the revival in US generics is leading the recovery over there. Then there is telecom, where we see that the competitive intensity has reduced because from 15-player market, it has become a 2.25-player market. And the recent flows that have come into the largest player in the sector have come on the promise of an increase in ARPU. And of course, that there is a large pool of consumers available, which are going to be a profitable consumers, hopefully, at that some point of time for them. The intensity to decrease ARPU has reduced. In fact, there is a pressure to increase the ARPU. So I think telecom is another sector that is going to lead the recovery. Also, with COVID striking, actually, telecom saw the least amount of disruption in the business. So that is another one. Then chemicals, specialty chemicals, besides the agrochemical, is also another space where the trends were firmly in place before the COVID struck, and they have not been disrupted because they are largely, again, rural and agri-focused. So broadly, these are the sectors. I mean, there might be one or two more like healthcare and diagnostics, but these are largely the sectors which are going to lead the recovery. And because market is abundant in liquidity, markets are not going to wait and provide you with an excellent entry point 6 months, 12 months down the line. When the clarity emerges that things are recovering, the stocks will be much more expensive than they are today. So I would rather that we focus on the sectors that are recovering and we position ourselves over there and let market do its own thing.
So what are the chances, Ravi, that when the actual recovery happens, markets may not rally because markets already have moved in anticipation of a recovery? Look at an example in 2014 when Prime Minister Modi for the first time came back, markets rallied, and then in a sense they remained flat for a substantial amount of time. We've seen that even happen when UPA 2 came to power. Market hit a double circuit and did not go anywhere.
True, but as you said, markets are forward-looking and markets respond to the incremental change. So if at that point of time, if market is still anticipating, let's say this year, the expected GDP print is anywhere between 3 and 5% negative. But markets are not going to respond to that because we are already looking through that. In 22, if the GDP print is likely to be between 4 and 6%, so markets will keep rallying until we get that print. And after that, then we will reevaluate whether this 4 to 6% is going to go to 8% or is it going back to 2-3%. So at that point of time, we will evaluate if the rate of change is still on the positive side or no. But at this point of time, worrying about that is too premature.
There are two important features, Ravi, which at least in my book are the differentiating factors. First is that you've got a very polarized large cap market. It starts with Reliance, perhaps end with, let's say, an Infosys. When you see a move like, or when you see a asset like Reliance getting created in the large cap space, does that worry you about the polarized nature of the market? Suddenly one large cap stock now accounts for 14-15% weightage of the Nifty?
I feel if ever Reliance had, first of all, I don't really comment on a particular company, but if there were fears about Reliance, that was 6-12 months back when they had a huge gross debt and net debt on their books. Now they have deleveraged themselves. Now the survival risk is gone. There were real questions on Reliance 12 months back, whether they will be managed to deleverage or not. So that question is out of the window now. Now the focus is on whether they'll be able to monetize the assets that they have created. And if the answer to that, which I just spoke in the telecom, if ARPUs are going to rise, then I don't think Reliance is going down anytime soon. The weightage can come down with the rest of the market performing. So what you were just mentioning before I logged in, I remember that the breadth is widening. The market breadth is widening, which is very, very heartening because there are few sectors that are leading the recovery. Besides only it has not been a sectoral move. It has more been a leader in a particular sector, which is taking away majority of the market share, leading to winner takes all kind of a mentality. And that was leading to this polarization. To some extent, I think this polarization in terms of market will reduce because there are more sectors participating. However, within a sector, it will still remain that the most strongest balance sheet will attract the most capital and it will attract the most market share also, the companies. So because the other companies are still firefighting and fighting for survival, in that case, the survivor is the strongest. And that's exactly what is playing out. But what you need besides a sector that is in which a leader is taking away market share is a tailwind to the sector. And if you can find few sectors with tailwinds, that is going to be double bonanza. And that's exactly what we witnessed in Pharma, that a small change from 8-10% kind of generic price erosion to 3-5% kind of generic price erosion, which was happening for the last 4-5 quarters. So such a huge rally in Pharma. So you need to be very sensitive to the positive change, and markets will actually ignore the negative change. I feel there is only one sector where there is still a lot of uncertainty left. Otherwise, majority of the market has factored in the worst of the earnings for FY21.
Do you think banks now, which account for 30-35% weightage, when I say banks financials, now at best will be market performers with a downward bias?
No, I think they'll be underperformer. As I said, this is actually one of the only sector left where there is still uncertainty. So just to give a broad perspective, this COVID is going to leave a lot of one-time losses in revenue for most of the corporate world. Now, these losses are going to be distributed amongst government, consumers, corporates, and lenders. Government has very limited ability to absorb those losses. Consumer also is bearing the brunt of that through the fuel price hikes. Corporates will bear some losses. But I think a bulk of it, the part that is the balancing figure, which we don't know, is what is going to be borne by the lenders. And that is why this uncertainty still remains. We don't know the extent of losses that the lending sector will have to bear. Is the moratorium going to be extended? Will there be a one-time restructuring? Once we get some certainty around it, that, okay, these are the losses, this is the capital that is, they are in a mode of frenzy in terms of raising capital, which tells you that there is a large capital erosion coming for which they are preparing themselves. And RBI is right in trying to prevent a systemic risk to it. And if you are going to have rising NPA and you are raising capital, both the things will depress ROEs. So in that kind of a scenario, financials are likely to remain an underperforming sector, at least until we get clarity on what is the way forward in terms of restructuring or moratorium, or what is the extent of these losses. If I were to go by what Mr. Uday Kotak says, then the losses are going to be a tune of 4 to 5 lakh crores. And if that is the case, then they will have to raise enough capital to take care of those kind of losses. And I think those 4 to 5 lakh crores will have to be spread over a long period of time. There is no choice. We cannot have, we'll need at least more than 1.5 lakh crores of capital to absorb those kind of losses. So I think this is a sector where I think you can safely, stay away from for next 12 months until clarity emerges.
And closing comments, Ravi, everybody is talking about, okay, retail is there and retail means that get rich quick syndrome has hit the market. I always make this point that what is sauce for goose is sauce for gander, which is that the same conditions apply for institutional investors and retail guys. And we should not get worried about the fact that retail is right now active in the market. What are your thoughts based on market experience? Because the word, at least on Dalal Street historically, has been that jab retail aata hai, market top hota hai.
Yeah, so I find this talk about a bubble in the market really, really ridiculous. If somebody has lived through a bubble, they would not make a comment like this. The corporate earnings have been falling for 5 years. Markets have not given any kind of returns for the last 5 years. The CAGR is like 3-4%. And retail participation, okay, because of this lockdown last 2-3 months back, some participation has come in. But is there a combination? What leads to a bubble kind of a formation? Sure, easy liquidity to begin with. But easy liquidity, usually a bubble is preceded by 3 to 5 years of such good earnings growth that the optimism is all around. And everybody tends to make a mistake after that kind of a run. Corporates tend to overcommit on the capex. Central bankers tend to be underestimating the risk. Traders, investors, everybody is high on optimism. That's not the case at all at this point of time. We are in, if anything, we are close to the pessimism and we don't want anything to do with equities kind of scenario. If you had asked this question to me in March, I would have completely told you that this is a point of maximum pessimism. So in that kind of a scenario, retail coming and participating, are they like taking money out of their business and putting in for the long term or any such thing, or are they doing day trading and options trading? Then all they are doing is really providing liquidity and having fun for themselves. I would not be overly concerned about it as an anecdotal evidence of a bubble forming.
Okay, so just to wrap it up, Ravi, and again, there is no direct correlation as to what's happening in FANG stocks versus what's happening in India. Look at the data points which you shared. Bubble happens when there is optimism, no cynicism, low liquidity, surge in earnings and over ownership. That will apply to an Apple, an Alphabet, a Netflix, even for that matter, other US companies. There is liquidity, there is optimism, there is a surge in earnings, and there is over ownership. What if these US tech stocks reverse? What will that do to the world and equities and developed markets and India?
No, you're absolutely right. If anything, that is where the strongest bull market is at this point of time. And I say bull market and not bubble at this point of time, because bubble is when you stretch things to the sky. So clearly, market caps of $1.5 trillion are very, very high, and they cannot keep growing at double digits, because sooner or later they'll be bigger than the whole planet Earth. So it cannot be stretched to the sky. Having said that, what COVID has done is actually crunched their timeline also. The kind of growth rates they were anticipating, let's say they will achieve some kind of numbers in digitization in 3 to 5 years, the timelines have been crunched down to 1 year and 2 years. So the near-term outlook for these companies has actually gotten even better. And so we are in a very, very liquid awash world. We are in a very, very polarizing world. And in that, this polarized companies, they are seeing acceleration of their earnings. It is more likely that these strong bull market converts into a bubble before it bursts. So, but at this point of time, I think you can say there is optimism in bull market and not bubble.
Okay, on that positive note, Ravi, we'll let you go. Good to have you on the show as always. Take